Ladies and gentlemen, welcome back to the 2020 Master Investor Show, Day 2. In our session for late morning today, I've got the privilege of introducing an old friend of Master Investor. That's Ed Marten of QuotedData. And he will be followed by Guy Anderson of JP Morgan Asset Management.
Hi, my name's Edward Marten. I'm the CEO of QuotedData.com. We provide news, research, data, and events for private investors. It's all free. It's paid for by the industry. We're building a village at Master Investor of investment companies. We're hoping to bring more property companies along. They've got a property panel here today. Do subscribe to our work. We have a panel of City analysts who are working continuously on news and research. It's all free, so do come. If I wind back the clock a couple of years ago, we had a panel where we looked into the investment companies market, explain why they are the largest and fastest growing sector in the stock market. I had Fidelity here, John Lang Capital Management, Janice Henderson, and then last year we had we looked into which investment strategies work and how they implemented. We had Chris Clothier from CG Asset Management, Dan Whitestone from BlackRock Throgmorton Trust, and Nick Bryn, who manages the Polar Capital Global Financials Trust, and that focus on from Nick on the value and income, Dan high growth, and Chris the absolute return mandate that they operate, has been particularly interesting to follow, especially through COVID, but also it really helps to add to the panel and focus on how they run how they implement their strategies and the differences between them. Today I will be taking a step back. Richard Williams has invited Richard Moffitt from Urban Logistics, Jason Baggaley from Standard Life Investment Property Income, and Standard Life Investment Property Income is a diversified play. Richard's Urban Logistics REIT does focus on warehousing, and I think the insight into with the diverse fund and a focus on logistics and warehouses will be particularly insightful to highlight some themes for the future in the property sector. So without further ado, I'll pass you over to Richard and enjoy.
Welcome to QuotedData's property panel session here at Master Investor, titled "What Will the Post-COVID Property World Look Like?" With positive vaccine news coming through, hope that life will return to some form of normality next year is increasing. The property sector has been heavily impacted by the pandemic. All but essential retail has been locked down twice now in the UK, and the hospitality sector has been even harder hit. Some trends have developed or have been accelerated during the pandemic that could have a lasting impact on the property sector. Working from home, for example, has become normal for millions of people. The impact on the office sector has been widely speculated, with some declaring the death of the office. That's a bit dramatic, but working from home is sure to have lasting effects on the way that the office is used, that landlords will have to overcome. The logistics sector has been one of a very few property sectors that have been relatively unscathed. More people have been forced into using online retailing, and large proportions of that is expected to stick when life gets back to normal. This has resulted in a booming demand for logistics space from parcel delivery firms and online retailers. Can this be sustained going forward? On the flip side, retail has been decimated. So what is the future here? To answer all of these questions and provide much more insight, we have two property stalwarts joining us. We are delighted to be joined by Jason Baggaley, Fund Manager of Standard Life Investments Property Income Trust, which owns a diverse portfolio including industrial, offices and retail, and Richard Moffitt, Chief Executive of Urban Logistics REIT, which, as the name suggests, owns logistics assets located close to towns and cities. Welcome, both of you.
Thank you.
If I could come to you first, Jason. As I said there's been much speculation on the future of offices. What is your view on how it will look next year and the years going forward?
Thanks, Richard. So with the future of the offices, I think the first thing to say is that in the short term, the economic environment is likely to be the greatest impact. So if we see higher levels of unemployment, that's less bums on seat. So office occupancy and demand is very often linked to the state of the economy. Over the slightly longer term, you're right, work at home has become a new norm. But I think what we're going to find is that it is part of a solution. Very few people will choose or be asked to work from home all of the time. And actually, flexibility and agility, being able to work in the best location for you to add value, will be far more important. And the way we use offices will change slightly. So they'll be used more for collaboration, learning, development, sharing. So we need to create spaces where people want to come to work. It will mean slightly less supply though. So over the short to medium term, there are some challenges for offices. The best will do well and the worst less well.
Yeah. And what has been the tenant response so far? What have they been saying?
But, you know, very mixed. So most people realise that the office is an area where they get the most out of people because they can share. The social aspect actually very important. And there's been a few examples where some people have said, right, we don't need an office anymore. And their employees have turned around and said, yes, we do. And they've had to retake space. But, you know, to be honest, it's been a huge learning experience. Most organisations haven't been back to the office since early March. So not only are people used to being at home, so organisations are dealing with it better with the way they manage their IT systems, etc. But most of them are looking forward to getting people back in the office. As I say, not all of the time, but most of the time.
So what will, having sort of some of the time working from home, some of the time in the office, what impact do you think that will have on space requirements?
So it's really hard to actually sort of pinpoint a space differential. I would say that pre-COVID, a lot of occupiers had come to the conclusion they could manage for the same number of staff with roughly 20% less space than they'd have had 15 years ago. Now that could increase maybe to more like 30, 35% reduction, apart from the fact there's going to be some offsetting, because we're also seeing a reversal of the trend of more greatly density of occupation. So desks have got smaller, people closer together. We've all sat in an office where the person opposite starts coughing and you wish they weren't there. Well, I think we're going to be really sensitive to that type of environment into the future. We're likely to see people just spread out a little bit more in offices, so that'll offset some of the less space needed. My guess is it's going to be somewhere around the 25% for many occupiers, but it'll vary.
Okay. And you mentioned earlier that the office will become more of a place for collaboration and things like that. Will that mean a change in the way the office is designed and set out?
Yeah, so predominantly within the let space, what you're likely to see is a change in balance between the area laid down to desks and the area laid down to open plan, breakout, meeting rooms, etc. Apart from anything else, we're going to probably need more meeting rooms with interactive screens, etc., so that you can collaborate with colleagues who may not be in the office at the same time as a meeting's taking place. Outside of the direct let space, I think we're going to see changes to the way we enter buildings. So more and more will become touchless, where because people are coming in some of the time, they'll probably have apps to book where they're going to be in the office, how they're going to arrange meetings with people. So technology is going to play a part as well.
Okay, that's really interesting. And you mentioned the word earlier there, flexibility. Will there be more flexibility in leases and things like that going forward?
Yeah, I mean, that's been a trend for a while, and I think there are two sides to it. One, occupiers, when they commit to an office and they do the fit out and they move, it's a big cost, which they write off over several years. So they're going to have some core space, which they're quite happy to commit on a longer term basis to. They're probably going to then want some flex space around that. So an ability within a building to vary the level of occupation easily and cost efficiently over time.
Yeah, and what impact will that have on you guys then as landlords?
So I think that the greatest difference is we're becoming less of a provider of space and more of a provider of service. So we will be expected to do more for the rent we receive.
Yeah, and obviously that has cost implications. Will that be shown in the rent that you can charge?
It's going to be really interesting. I think the rental differential between buildings which work for tenants and those that don't will increase. But it's actually about the sustainability. So actually, if you've got a building which has some flexible elements to it, really appeals to tenants, so great working environment, you'll have a longer sustainable income stream. Although the lease may not be as long, the building will appeal, so your sustainable income remains higher than on a building which perhaps can't meet those needs.
Yeah, that's interesting. And then what do you think will be the sort of overall impact on rents? You obviously say there's going to be less demand for space. Will we see a drop off in rents going forward? Is that inevitable?
I think it's going to be mixed. Different locations will have different experiences. So part of it will depend on how much space gets taken up for alternative use. We've already seen that on a big scale in many locations where poorer quality offices have changed use historically to residential and hotels. We may not see quite as much hotel operators taking the space in the near future. But alternative use will remain an important factor. Actually, if you look at places like Bristol, you could well find that there's already a shortage of supply. That only increases as more people want to work in locations where they can live in a fantastic environment outside and get into it to work easily. So I think we're going to see a different solution and different rental levels in different locations.
Yeah, it's interesting. Yeah, the debate on locations. It's been a lot of, like I said at the start, there's been a lot of speculation on the office market, and I suppose that speculation has been bred by no one knows what's going to happen. But one of the terms that has come out quite a lot is the hub and spoke model, where they have a central HQ and then smaller sort of satellite offices, maybe in serviced offices around a city like London or Manchester or whatever. Is that something you can see?
Yeah, I mean, it's been talked about an awful lot, and I think one's got to actually think about what people want it to achieve for them. So generally, if you look at any city centre, if people live the whole way around the city, the only accessible location to get people together is the centre of that city or town, because we don't have great communication around it, particularly by public transport. It all goes into the middle. So what you might find is, particularly in the largest places such as sort of a London or a Paris, maybe organisations do arrange some hubs where people who live in a particular area can go to easily if they don't feel they can work from home well enough. So we've seen a few examples of some of the suburban London service office occupiers seeing an increase in demand for 1 or 2 desks. But it's hard to see how someone would say, we'll really reduce the centre in London, but get people to move, spend time in our regional office around the outside, which is actually harder to get to for half the people. You know, offices are going to be about having the right mix of people in at the same time.
Yeah, no, I agree with that. Okay, and then obviously the logistics sector has not had so much of these issues to contend with looking forward. I know obviously Urban Logistics REIT is entirely focused on that sector. Jason, your portfolio is about 50% in the industrial sector as well, isn't it? So you obviously both know that sector well. The huge rise in demand for space that was seen at the start of the year, sort of March time. Can that be sustained going forward, do you think, Richard?
I think it can. I think the important thing to remember here is that all the traditional supply and demand statistics have tended to ignore what we call grey space, which is the space that occupiers are actually paying rent on but not actually utilising. And if you go back to the GFC, I think DHL, by way of example, I think had about 5 million square feet of grey space. And if you multiplied that out across all the major carriers, you'd probably find there was probably about a year's supply in grey space. Fast track to the start of the pandemic, or the lockdown that resulted from the pandemic, and almost none of those major carriers had any grey space. So first of all, the market is much tighter than we'd anticipated previously, but I think also the PPE, which apparently about a third of the containers coming into Felixstowe currently are containing PPE. My estimate is that PPE accounts for something like 15 million square feet, potentially up to 20 million square feet this year, which again will take about half a year's supply. So I think the imbalance is greater than it's ever been before, and allied to the fact that the growth in online penetration has gone from 19%, I think it was in March, to in January rather, to 32% by March, and that's the bit that's getting people very, very excited from an investment perspective, property investment perspective. But I think the other point to make is that what we're seeing on the ground day to day is a situation where occupiers are very keen to secure their long-term futures, and that's having a very positive effect from an asset management perspective.
Yeah, you mentioned there about the supply-demand imbalance. So do you want to talk on the supply side, because that has obviously been dwindling over a number of years?
Yeah, I think last year in our market size, which is typically 20 to 200,000 square feet, there was about 3 million square feet of speculative development against the take-up of 8.5 million square feet. So clearly there was already imbalance there before the dynamics that I've just referred to came into play.
Yeah. And
I mean, the market will respond. There will be more speculative development, but equally there will be an increase in demand as well. I think a lot of the larger operators sophisticated their big box strategies over the last 10 years, but I think they really only started to focus on the last mile piece over the last 5 years, and I think there's still quite a long way to go. Yeah.
And for people sort of unfamiliar with the sector, what exactly is the last mile that you talk about?
Well, I think we're very focused on last mile in the UK. The Americans call it last touch. We prefer the American vernacular because I think it more accurately reflects the fact that a product can go on its last stem journey from a warehouse to your home or your business, which may be 1 mile, but it may also be 150 miles. So our warehouses are full of operators that are looking to take product on its last stem journey, and I think that's the point really. It is everybody calls their assets last mile today because it's the fashionable thing to do, but in reality, what we're talking about here is pure logistics, no manufacturing. But you know, the market differentiates itself into the traditional hub and spoke model, the economy parcel sector, multiple parcels collected and delivered by vehicles, usually vans, from multiple addresses. And the next part of the market is the same day delivery model, which is probably, if you go back to 2016, 17, 90 to 95% of the market was the traditional hub and spoke model. Whereas today we're seeing a nationwide increase in the amount of same day delivery. So as a consequence, that change will involve occupiers looking at different buildings, different locations, and that's why I'm so confident about the next 5-year period.
Yeah, that's interesting. And obviously with the pandemic also came the shock in the supply chains of most of these companies, retailers and such. Has that had an impact on the demand for sites?
I think the pandemic has certainly seen a rise in the volume of online purchasing. But the bit that we haven't seen so much publicly is actually the effect it's having on the occupiers. And what we're seeing day to day now is a situation where occupiers are very keen to secure their long-term futures in terms of their buildings. So we are seeing customers now come in and seeing them look to lengthen leases. Clearly good from a real estate perspective, but the other part of it is ESG, and we're seeing significant investment now in car charging points, low energy lighting, solar panels, and so on and so forth, all of which is positive from an asset management perspective.
Yeah, and obviously the industrial and logistics sector is that it's made up of many sort of subsectors. Obviously the last mile one that you're focused on, but are there any in that in that industrial and logistics sector that you're sort of worried about? Obviously there's a recession, which we don't know how long will last. Is that a worry for you?
I think we're probably less worried today than we maybe were 5 years ago, because as the parcel sector was evolving, so there was a lot of consolidation going on. Clearly, we're very focused on our tenant covenants, and I think 87% of our income comes from covenants rated low or low moderate risk, according to Dun & Bradstreet. We're very focused on those larger operators, and our buildings, being of the size they are, tend to be the domain of those bigger operators, the DHLs and the XPOs and the FedExes and so on and so forth. Yeah. So I think I feel there will be winners and losers as the market consolidates, that there's no doubt. But I think we've already seen quite a lot of that.
Okay.
It's probably worth also just articulating where last mile sits in the whole industrial and logistics space. I mean, generally speaking, big box is 300,000 square feet and above. And then you have the urban logistics from sort of 20 to 30,000 square feet, ranging up towards 250, 300. And then obviously the traditional multi-let estates, and indeed trade counter operators, which are, quasi retail.
And it's the, I suppose the multi-let industrial side of things that could have, a recession could have more of an impact on. Is that what you're seeing, Jason?
So far, this recession hasn't hit households moving, etc. In fact, we've seen an expansion of house moving and purchasing, which is very supportive of the DIY sector. It's very supportive of the small showroom, and not showrooms, the DIY carpets, tiles, trade counter type of users. So that's remained remarkably resilient in a recession. That's normally one of the first areas which gets hit, and I think we need to be wary about that. Manufacturing has obviously declined in the UK. We might see some more onshoring, which will help because of supply chain issues, but we take a cautious stance at this point of an economic cycle towards some of the smaller tenants in the smaller units.
Yeah, that's understandable. So we sort of focus on the retail sector now. Obviously, that's been in a sort of state of demise for a while now, way before the pandemic or anything like that. How do you see that sector performing going forward, Jason? Is there any hope for it moving forward? Is there any subsector that's become interesting now? So
I think it's fair to say that the retail sector as a whole has got headwinds continuing. It's not looking particularly rosy. In fact, work from home, something we talked about, the impact on offices, I think is another nail in the coffin for some retail, because there are a number of outlets which did very well for click and collect. The ideal solution for retailers was click and collect rather than home delivery. That last mile actually is a very expensive element for retailers, particularly when there's no one at home. Parcels have to be re-delivered several times. If people are working from home 2 days a week, say, that you've solved that difficulty of actually delivering to them, because people can select the window of opportunity when they're in. And that's my doorbell ringing, which is probably another parcel, as an example, being delivered. So I think, you know, retail's got real headwinds, but areas of it will do okay. Convenience, food, I think we're going to see more of a move back towards that local convenience shopping. I think people quite enjoyed during lockdown being able to shop locally. But fashion to me is the area of greatest concern.
Yeah, understandably, if you look at the impact that online retailing has had on fashion particularly, is there, you recently bought a B&Q unit. Is that side of the market a bit more attractive sort of characteristics going forward?
Obviously, I've got to say yes. Look, we bought that asset for a variety of reasons. We believe that Kingfisher B&Q's a strong covenant that will pay rent for the duration of the lease. And it's quite a long lease, 11 years, and an attractive yield, 7.5%. So the unit worked very well for us in its current configuration and lease, and it's got some great alternative uses into the future. But I think actually what I liked about it was the tenant makes money from it. It trades very well for the tenant. And for me, if you look at retail, affordability becomes a really important aspect. So, and that's why I'm less confident about fashion. Generally, the highest rents are paid on fashion parks, outlets, etc., and it's less affordable. So, you know, if I look at the portfolio we've got, we focus more on a B&M paying £8 or £9 a square foot than a fashion retailer paying £35, £40. And for me, that affordability is a really important aspect when we're looking at the sector. Yeah,
I am right in saying that there are quite a few of those discount retailers that are really expanding in the retail park sector. So, like you mentioned, B&M, Home Bargains. There's also you have Lidl and Aldi as well.
And other brands do exist.
Yeah, of course. But is that demand there? Is that something that's interesting for you on the investment side of things?
Yes, it is. But I think one really has to appreciate that they have a price point. And one of the things I find quite interesting is if one's looking at prospective purchase, and you see, you know, a range of units perhaps, and you say, okay, well, if that tenant were to leave, who would come in? And you realise it's a discounter. You've got to make sure you understand the rent they'll pay, because it may not be the rent which the current tenant pays. So yes, they are expanding. Several of them are doing exceptionally well, but they have a price point.
Yeah, no, that's interesting. And you mentioned earlier click and collect. I know Next have put a big emphasis on sort of getting people to collect as opposed to sort of home delivery. Is that something that could be a advantage for the sector going forward, or do you think customers want home delivery now?
Yeah, so click and collect is an ideal solution for retailers. Returns, people not being at home, the cost of last mile, people don't like paying for it, all added to the difficulties for retailers. And we've all heard horrendous stories about returns just going to waste because the retailer can't cope with them. So click and collect actually was quite a good solution for them. You know, we all hear stories of someone that orders 5 shirts of different sizing. If you go with click and collect, actually try it on and you walk out the one you want. If it's for internet, they have to deal with the cost of return and the difficulty of dealing with that return. And also, I think it was John Lewis always used to say that when someone turned up in the shop to collect something, the average additional spend was £12 from going to the shop. So click and collect was most useful for the retailer. It remains a valuable source for people who want ease of trying things on. But I do feel that we're all getting very used to our goods turning up at home.
Yeah, no, I agree with you there. And do some of the there's been a few bits and pieces in written about this. Do you feel that some of these retail parks and maybe even shopping centres that are sort of losing tenants and things, can they be repurposed into last mile logistics? Is that something that's easily done, or is it not? Is that a bit sort of pie in the sky?
So for the average shopping centre, very difficult. Most people with shopping centres are looking at a more of a mixed use approach. So predominantly residential with less retail. Out of town retail warehousing, there's greater opportunity for change of use. A lot of it will depend on the characteristics. So is the floor loading sufficient? Are the building configuration, can you get the right loading? Although you have a big car park, is that configured right to be able to load and unload? So that it'll work for some. I would also caution that pricing is everything. So if you had a retail warehouse park which you bought in 2005 for a 4.5% yield and it was at £50 a square foot, you're not going to get out scot-free turning it into an urban logistics unit.
Yeah, no, that's good.
On the face of it, retail parks and certainly some of the first generation bulky goods boxes could be converted to last mile delivery hubs. I think the reality is, though, the practical implementation of such a strategy is going to be quite difficult. I think fundamentally local authorities who gave planning consent for retail boxes, GVs, thundering up and down main arterial routes through towns and cities. So I think that would be a challenge. I think also from a specification perspective, I think a lot of these buildings won't have the floor loading required. And indeed the boxes themselves probably don't have the right specification for last mile delivery hubs. So I think whilst it's by no means impossible, and there will be good examples of it, I think in a number of situations that won't be quite as easy as people envisage.
Okay. So as we've seen, property is a very specialist and nuanced sector with lots of different subsectors that play in lots of different characteristics. Can make it a minefield for investors who are looking to invest in a property company. What would you say, Jason, is the key thing for investors to look out for before investing in a property company?
So I think for the last few years, there's just been these high-level thematics about have lots of industrial and very little retail. I'd suggest that we're moving beyond that phase at the moment. You need a company that is willing to take an active approach, that understands the markets it operates in, so experienced management team who've perhaps been through a cycle or two or three. The risk control environment, I think we are naturally in real estate, we're all very optimistic people. You need a good risk control framework. And other than that, I think, look at a track record.
Yeah. The experienced sort of management team, I suppose.
Experienced management team that has learned from what it's done in the past.
Yeah. Okay. And the same question to you, Richard?
I think retail investors should look for strong management teams, for teams that have a good depth of experience, because we live in an ever-changing world, and I think it's, for all we're seeing, a lot of change in terms of the acceleration in e-commerce and the migration to same-day delivery and all of these sort of relatively new models. The reality of life is that we still have a traditional real estate cycle, and I don't see that changing. So it's important that the management teams have the right experience, that they don't get carried away with the hype, and that buildings still need to be fit for purpose. The locations are still as mission critical as they always were. And I think that would be the single most important thing for me.
Well, thank you both, Richard and Jason, for your insight. Of course, if you want to learn more about what they do in the property world, including news, research, data, and more invitations, please do sign up at QuotedData.com, which is a free service funded by the industry. And of course, please do visit our stand and our stands of our clients that we've brought here today.